And good afternoon. Welcome into Market Talk for Tuesday, November 17th, 2020. I'm your host, Jesse Allen. Great to have you here. MarketTalkAg.com. That is our home on the web. You can find us there. You can find previous episodes archived there, as well as on your favorite podcast sources, including Spotify, Apple Podcasts, iHeartRadio, Radio.com, SoundCloud, Amazon, and Audible, and so much more. Also, our great radio partners, including KMA in Shenandoah, Iowa. Joining us today, we got a great day in soybeans and really a good day across the markets to talk about with Brian Splitt from agmarket.net as our guest here today on Market Talk. Let's bring him in here. Brian, how are you today?
Doing very well, Jesse. Thanks for having me on.
Hey, I appreciate you joining us here for the first time, Brian. And, let's dive right into this thing and talk about the markets. Today, soybeans, another great day. New highs we're looking at there with tight supplies in the U.S. It sounds like kind of one of the big drivers, but I mean, we were up 16 and a quarter today on January beans, up to almost 11.70. And I think a lot of people are starting to wonder, is that $12 mark going to be reached on the futures trade? What are your thoughts on the soybean market today?
Right. So the November report having come and gone and having soybeans still above $11 does really lend credence to the idea that we should see $12 a bushel. And really that's just because when you look at a continuous chart of soybeans in the last 6 years, we've only been above 11 once. And the month that we did that back in 2016, we hit $12 that same month. So I think that's what a lot of the trade is thinking is, this is kind of rarefied air. We had a report in November that was bullish. It was not a bearish surprise. And so now that we're above 11 and we stayed above 11, the expectation is that we should see 12 by the end of the month.
Yeah, and I think a lot of producers are kind of hoping to see that. But also, I've heard from a few producers. I just had one reach out to me earlier today and wanted me to ask the question. We've talked about a little bit on the program, despite $12 being a real possibility on the board here, a lot of producers are, wondering, could the bottom fall out here? Should I get some, get a floor set underneath me here if I'm marketing soybeans? What are your thoughts on that, Brian?
So the fund length is definitely something to be mindful of. When you look at the fund length in both corn and soybeans, we are seeing very large, aggressive fund long positions. And so that does make it susceptible to some major position covering if there's some kind of a macroeconomic event. So we're going to be at a lull of government data from the USDA. The December WASDE report usually says the same exact thing as the November WASDE report. So typically the expectation would be that we won't see the USDA really change the balance sheets much until the January final production numbers. So will we get a bearish report prior to that to make this market turn around? Most likely not. So I think the biggest risk is going to be something that happens on the macroeconomic side, whether it's a resurgence of COVID lockdowns. Could that force the fund community to want to cover positions? Absolutely. But in the absence of that, as long as we continue to see demand, I think the majority of the pullbacks will be just that, pullbacks. But we do have to be mindful of just the sheer distance that the soybean market has traveled. So we've been really a proponent of a couple things. I think one is if you wanted to sell some cash soybeans right now, you can very easily change your ownership position into something more conservative. So your cash position has 100% of the risk of the futures market, and that is also 100% of the reward if the market continues to go higher. But now that we're approaching 12, do you sell some of those cash bushels, maybe replace it with the July bull call spread, buy a $12 call, sell a $14 call, keep it non-marginable. Now your risk on your soybeans is the price that you're paying for your option position, and you're eliminating the downside risk of the beans themselves. If you don't want to go about it that route, and you're looking at more just using puts to protect the market, the January soybeans are trading above March and above May and above July. So any puts that you're buying probably should be bought off of the January, because January is inverted above all the other contracts.
A lot of great insight there into that soybean market, Brian. Let's shift over to corn. We tested that 424 mark here. I believe it was last week or the week before. I can't remember, but we're starting to kind of creep back up towards that here today. After we saw a couple losses late last week, we were up 4 in that December contract, 420 and a quarter today. March up 2.5, 426 and three quarters. What is your take on this corn market right now, and what are some opportunities out there for producers for marketing?
So on the corn side of things, very similar to soybeans, we're still very much in an upward trending market. There's a very well-defined upward trending channel. And looking at the March contract right now, and that's where the open interest and the volume is going to be. December is still the front month, but we will be seeing options expire Friday, and then we'll be going into delivery next week. So that's something for listeners. If you have any long December future positions in any market, whether it's corn, soybeans, wheat, meal, you want to be out of those by the close on Wednesday prior to Thanksgiving. Otherwise, you run the risk of being delivered on that position. But as far as the corn market directly, I would say that right now we're in a very well-defined channel. The upper end of that channel is going to be in the upper 430s, so that 437, 438 area. The lower end of the channel right now is really right around 410. So there's a good nearly 30-cent range between the low end of the channel and the upper end of the channel. I think that right now we need to see the contract for March take out, what was this, the 408 and three quarter low that we had the day before the November WASDE report in order for this trend to look suspect. If we did that, we would take out that report low that was last week's low. That would take out the uptrend as well. As long as we're not doing that, the trend is up and the path of least resistance is higher.
Yeah, and I agree with what you're saying there. It seems like this corn market there's some great room. It's kind of like soybeans, some room for a little bit of profit taking here if I'm a producer, and the upward trend is nice. I have heard from some producers, Brian. They're a little more cautious with corn, but kind of seems like you're thinking, maybe it's kind of along the lines of soybeans. Maybe they don't have to be overly cautious. There is some room for opportunity here.
Right, and so we don't want to forget where we came from. It's great where we are right now. The fact that we've got corn trading near 4.30 in March and soybeans are near 12. But I don't want to lose sight of where we were just 3 months ago when we had soybeans below $9 a bushel and corn was just above 3. So I do think that if a producer has some concern, again, really at this point, COVID is probably your main risk. That's going to be for corn. Just the fund length alone is one aspect of that. But we saw what COVID and the decrease of driving did to the demand for corn for ethanol. And so that still could be something that comes into the future. So again, when you're looking at the structure of the corn market, there's about 6.5 cents of carry from D's to March. March to May is 3 cents, and then May to July is a penny. So if I'm doing any hedges in corn, I'm really placing them in the March contract. That's where the bulk of the carry is. And I think you could continue to, if you have concerns, just layer some puts under the market, leave the upside open. But that would help keep you, if there was a catastrophic move and the market did roll over for reasons outside of the fundamentals of the corn and soybean balance sheets themselves, you're not going to have this rally that we've had taken away from you in a full swoop move.
You mentioned COVID a couple of times, Brian. Let's focus on the livestock market a little bit, because obviously COVID is concerning everything in our world right now, but that's been a big driver in this livestock market. I know today cattle futures did trade modestly higher, and they've kind of been stuck in this sideways range, really haven't gone one way or the other. But what did you see on that cattle market today? Anything encouraging there?
Box beef was up a little over $6 on the choice, and so the market liked that. We were up a little bit prior to the box beef data, but once those numbers dropped, the market went and made some new highs. I've been really focused on the February contract for the live cattle futures. Predominantly, we've been in a range between about 111 and 116.50 or so. There were some concerns that we had about the resurgence of COVID and what that might mean for packing plants. And so we did have a pretty large correction down to that 105.50 area. And if you actually go back and look at the lows we had in April to the highs that we've made as far as the recovery high, that took back about half of that rally. So we went and retraced a 50% retracement. They bought that dip, and now we're back into that old trading range. So I think you've got the optimism from the Pfizer and Moderna vaccines, the efficacy rates, the way the stock market has reacted to that has supported cattle. But really, when you think about it, I think the most optimism, and you can see this by some of the deferred contracts, your June, your August live cattle futures, those are the ones that have gone and made some new highs recently above some of that resistance. And I think that's the expectation that with higher corn prices right now, animals may be fed to lighter weights. And also from the aspect of the support from the vaccine, that's probably going to be an issue that's still several months down the road. So these things are probably more supportive to some of the deferred contracts than they are the nearby ones.
Well, and we'll have to see as well retail values here as we go through the holiday season with people eating at home, if that has any effect on the beef markets. But I noticed as well some sales in the countryside today, Texas, some bids in Kansas. So maybe some early week buying there might help out and support this cattle market going through the rest of the week. Brian,
Yeah. Can I make one more point to your point too? And this is just my family, but I think these gatherings are going to be much smaller in nature this year. So, normally we would have all the aunts, all the uncles, the grandparents, cousins, everybody's over. This year it's going to be much more intimate. So rather than have a large turkey to feed everybody, we're going to do a tenderloin. And so I think when you have a lot of families that are eating out less, spending more money at the grocery store, probably potentially more willing to pay up a little bit for some beef rather than eat turkey this year is my thought. So we could see at-home beef demand significantly higher than normal for this time of year.
Very true. Very true. We could also maybe see pork demand higher as well if people want to have pork instead of turkey or beef. And I know looking at this hog market today, a good day there. Hog cutout futures, they were higher, it looked like, for the most part today. This hog market's kind of, I know some people have been a little bit hesitant with this hog market. We've been holding in this mid 60s range. What are your thoughts on what's going on with hogs right now?
Well, I look at the market right now technically and just kind of glancing at the chart here real quick. The market's been trending higher since early April. And the lows that we had yesterday and where this market really turned around from today is right at that long-term uptrend. And this starts from April and hits some points that we had back in June and late June and then in August. And so it's a very well-defined uptrend. I imagine you're seeing some technical buying and some expectations of some additional export demand on this pullback.
Yeah, and export demand, that's been the one thing that we've all been witnessing, and some people are worried with everything. If China, are they going to continue this, this buying that they've been doing from the US with South American crops getting drier and some questions down there. Everyone's kind of watching China right now to see if that export market for grains and beef and pork, if that continues to be strong.
And so that is going to be the potential determining factors over the next several months of whether things stabilize on corn, for example, around a 1.7 billion bushel carryout. Maybe we see an adjustment in January on the size of the crop, so that will affect the balance sheet in that respect. But we still feel that China has more corn needs. When you look at what their estimate of their ending stock was at the end of the 2019 marketing year, which ended at the end of August, they were expected to have a little over 200 million tons of stocks. And that was dropped on this most recent report down to just over 191 million. So the USDA did increase the estimate of their imports to 13 million, but we don't think that's enough. That just increasing those imports now brings your stocks back up to where we thought they should be at the end of the marketing year. So in order for them to build stocks to where they had them in previous levels, which would be anywhere between 210 to 220 million tons. If we're going to try and go back to that type of stocks level so that they can feed corn internally, then we need to see them import more. And so that doesn't mean it's going to come all from the U.S., but as we watch the South American weather, and sorry, my partner's phone over here.
It's all right. It's all right.
To get it off. So as we look at what we expect them to continue to need to import, if South America has issues, specifically with the Brazilian safrinha crop, that's going to push more of the Chinese imports to the U.S. And I think we could potentially then have a very strong export program this spring.
Yeah, a lot of great insights there, and your take on China is definitely one I think a lot of folks are hoping we see happen. Brian, any other final thoughts on this market today? Again, good day here on Tuesday. I think a lot of people happy after today's market closes, but any other final thoughts you want to share?
Yeah, just I think the dollar is at a very critical level right now, and the U.S. dollar could potentially be the gatekeeper between seeing what looks and feels like somewhat high prices now compared to what we've been used to over the last 5 to 6 years to substantially higher prices. And so the dollar has been trending higher for roughly the last 9 years. The last 4 months have been really riding along that uptrend. We've got the 100-month moving average right there at that trend line as well. So interestingly, the corn market is interacting with its 100-month moving average. And I think seeing the dollar index, if we were to break down below this uptrend, below the 100-month moving average, we're likely to see that inflationary mindset really kick in. And I think that could be the catalyst to seeing the market really rearing to go and seeing some substantially higher values. So we're keeping a very close eye on the dollar. I think the lows that were made in September are kind of that gatekeeper per se. And if we could take out the September lows, I think we're going to go on to a full-fledged inflationary bull market.
Well, a lot of great insight into the marketplace. And Brian, if folks want to reach out to you and the team at agmarket.net to get a little help with their marketing needs, what's the best way to do that?
First of all, you can check us out online at www.agmarket.net. You can reach anybody at the Ag Market team at 844-4AgMarket, so 844-424-6758. You can reach me directly at 815-665-0463. And my Twitter handle is @BJSplitt.
Awesome. Well, Brian, I appreciate the time today. Great to have you on Market Talk. Look forward to having you on again in the future. Thanks so much.
Thanks, Jesse. Appreciate it.
Brian Splitt with agmarket.net, our guest today here on Market Talk. You can find us online, markettalkag.com, and again, on all your favorite podcast sources, including Spotify, Apple Podcasts, Amazon, Audible, iHeartRadio, radio.com, and many more. This has been the Tuesday, November 17th edition of Market Talk. I'm your host, Jesse Allen. Have a great afternoon.